Well, from now on, let's begin with solvency management. As explained earlier, we are trying to calculate our capital and risk very accurately. It's mainly because we want to control our capital and solvency ratio. Solvency ratio is a ratio that's available capital. It means what we have divided by the risk. It means what we have to have or being required to have. Available capital means a capital or a net asset that could be used when it comes to experience a loss. Required capital, which is very similar to economic capital, and risk, as I've explained earlier, it's an unexpected loss in a certain confidence level, such as 99%. And it is also defined as a risk and volatility. This measures what we explained earlier as a risk in the first chapter. Overall solvency ratio is very, very strictly regulated and monitored. In Korea, minimum requirement for solvency ratio is 100%, and most company controls over 150%. The minimum requirement is different from countries and regulators. In the financial market sector, there exist similar solvency regulations as well. Banks have to adopt BIS capital adequacy ratio, and stock and investment companies have to follow NCR, net capital ratio. The logics are very similar to reinsurance's solvency ratio. Industry's key risk is predefined, called as economic capital in reinsurance and risk-adjusted asset in banks and total risk in the investment side. In reinsurance, insurance and investments risk is the main risk, and for banks, market and credit. And for the stock market, market and counterparty risk is the most important. Minimum requirement for solvency ratio is also diversifying upon industry as shown. One thing here we have to remind is that in the reinsurance industries, there were very, very diversifying and different regulations among countries and regulators as shown below. But market consistent value approach shown in insurance liability is a trend for now. As for Korea, we used RBC, which is derived from US regulations. We used RBC over the last 10 years, but Korean regime is shifting right now to KICS, which is very, very similar to European solvency. KICS will be implemented targeting from 2023. Well, here we will briefly introduce RBC summary, which Korea is using right now. RBC, known as risk-based capital, is a Korean standard regulatory solvency management system which encourages insurance company to have sufficient capital to compare to its risk. Available capital, we've explained several times, is that amount of capital that a company has, and it's a numerator in a solvency ratio. Required capital, same as economic capital, and risk is a denominator, and it represents amount of risk a company is taking right now. For the insurance risk, there's a premium risk and reserve risk. Premium risk is expected premium compared to actual claims. It's closely related to correct calculation on premium, and reserve risk is accumulated OSN IBNR, which is called reserve, compared to its actual payment. So it calculates based on a correctness of reserve. For the credit risk, it's investment asset and ceded reinsurance default risk. For the market risk, it calculates price decline of investment asset by stock market and foreign exchange rate changes. For the interest rate risk, it measures net asset deviation from interest rate changes. Net asset means interest-related asset minus interest-related liability. For the operational risk, it measures human risk. It's a narrow modeled risk. So in Korea, we use 1% of inward premium as an operational risk. For the integration, we are using correlation metrics given by FSS, our regulator. One thing I want to comment is risk charge and correlation effect. All of those are given by regulators, and the regulators are using Korean industrial statistics over the 10 years. Another thing to add on is liquidity. It measures insolvency. It measures whether a company could pay its liability payment in due. In liquidity, we and almost all of other reinsurance companies control by liquidity ratio management, not a solvency ratio. It measures L ratio by probable liquidity assets divided by liability in due. In here, we will briefly review the structure of the capital. The first one on the left side is an accounting capital, defined as net asset in a balance sheet. Available capital is capital plus other add-on and minus. Cat reserve tax is one example in add-on, and unexpected dividends is an example in minus. As explained earlier, available capital is the numerator in solvency ratio. Required capital, which also known as risk and economic capital, consists of some predefined risk, such as market and credit, insurance, and diversification effects. Required capital is closely related to and is a basis of strategy of reinsurance company, because most of reinsurance companies have a target solvency ratio for its strategy. For example, 200%, and managing its capital allocation in due courses by the strategies. There are standard and internal one, and in a standard and regulator capital measures, such as RBC and KICS. Regulator, it means FSS in Korean, decided both of available capital and required capital. Whereas in an internal model, a company could decide both measures to reflect its own characteristics. Let us explain this in detail later. The next part is capital shield strategy. It means to prevent lower solvency ratio and control too high ratio too. It is important for a reinsurance company to maintain a stable solvency ratio. It's mainly because a stable solvency ratio is related to pursuing an active business strategy for increasing profit, which results in ROE improvement. Normally, a reinsurance company would have 3 different status in terms of solvency ratio: sufficient, stable, and deficient. We are pursuing a stable status such as 180 to 200% of ratio. If solvency ratio is sufficient, for instance 250%, then we could use our capital more efficient and aggressively, such as overseas expansions and M&A, and strategic business decision making, such as high risk, high return strategy. This could lead a reinsurance company with a potential increase in ROE. In contrast, if solvency ratio is far below our stable range, it is called as deficient status, such as 150%. Then we have to prepare a recovery plan to recover our solvency ratio. It includes decrease in premium volumes in businesses and decrease in dividends. Overall, managing solvency ratio is the key strategy that reinsurance and insurance companies choose. Well, this is the brief and the solvency ratio management. Let's begin with capital modeling later on. While we're gonna explain capital modeling. Capital modeling is the process that calculate or require capital risk. I explained several times. Briefly review on a model first. There are two types of models. One is a standard model, also known as regulatory model, and the other one is an internal one. For a standard model, all risk calculation method that we reviewed earlier is predefined by regulator. Regulators develop a risk charge and calculation method by using industrial average and statistics. Standard model is a mandatory one, and there is a minimum requirement for each category. One of the example on standard model is Korean RBC and K-ASEAN as explained, and there is no need to capital model in standard model. For an internal one, risk is calculated by internal and actual characteristics of our own company by using our own statistics and global business distribution of channels. And once a reinsurance company get an approval from regulator, it will replace mandatory standard model to internal model. Then we need to have internal capital modeling to use internal model. Here we can briefly compare calculation method with standard and internal. For the standard one, non-life risk is premium and reserve multiplied by risk charge. It's predefined. And for the life, shock bell minus bell. A bell means best estimate of liability, and it means current market value of liability in IFRS 17. For the investment, it measures exposures multiplied by risk charge. All the risk charge and shock is given by FSS using by industrial average. This method is using for calculation in KICS. And internal model, for the non-life, we are using DFA. DFA is a dynamic financial analysis tool. It's a simulation package, insurance, and overall internal model. It's very close to simulation tool and is highly calculation one. And this is for the non-life internal model. And for the life, we are using shock bell and bell, same as regulatory one, but the shock is our own statistics. For the investment, we are using exposures multiplied by ESG, which is also simulated. ESG means economic scenario generator, which we are given by many vendors to predict and forecast our interest rate movement and stock movement as well. To briefly, internal model for the shock and the simulated statistics in DFA and ESG are all used by our own statistics, our historical data. That is the biggest difference between standard and internal. This shows how the brief chart, how we calculated solvency ratio in a standard model and internal model. As you can see, the left, standard one is more like a simple math, whereas an internal model is more like a analysis, deep analysis, and relying on our statistics. It requires to define our risk categories and scenario definition at first, and by using our statistical tools, DFA, as explained earlier, we've set up a loss distribution and modeling dependencies, and finally integrations. Here are very brief, just you understand that there are differences between standard and internal. There are some outdoor vendors which develop an internal insurance risk modeling platforms. They are using a statistical mathematical expertise and reinsurances experiences to analyze all of these processes. Igloo and Remetrica is the name of the platforms, are the most well-known platforms in the reinsurance industry is using right now. Global top 4 reinsurance, such as Swiss Re, SCOR, and Munich Re, and Hannover Re, all of them have full internal model and approved by regulators. Most of them have first developed a partial approved one, not a full one, and revised several times over the 10 to 20 years. Same as Korean Re. Separate from capital modeling platforms like Igloo and DFA, there is also a cat modeling. Cat loss, such as earthquake and hurricane, could be reasonably estimated by cat modeling. One of the biggest potential loss exposure in reinsurance company is earthquake and hurricane, so it is really important to control the cat modeling. For the cat modeling, actuarial science, financial engineering, methodology, and seismology are very important. We need to study math, statistics, weather, and earth. The origins of cat modeling was from 19th century, where mapping risk and measuring hazard. Then from late 80s, by improvement of GIS and computer, the cat modeling is developing well. The history and development in cat modeling seem to be followed by severe loss, as you can see the chart below. RMS and EQE cats. There are two of the biggest cat modeling vendors were originated from 1988 and 1994. There are 4 vendors in capital modeling, and one is cat modeling, and one is AIR, founded 1987 in Boston, and wholly owned subsidiary of Insurance Services Office. Another one is RMS, Risk Management Solutions, founded 1989. And the other one is CoreLogic. Previously, it was EQCat, and is founded in 1994. And the last one is Impact Forecasting. We call it IF. Wholly owned Aon. Aon, one of the biggest global reinsurance broking companies, and it released July 2010. And here are the examples of cat modeling vendors. Well, this could be the end of introduction of capital modeling, and I just want to remind that there is a internal capital modeling for measuring internal capital risk for the reinsurance company. And for the reinsurance company, it is very, very important to control CAT modeling. They are also using CAT model. Well, this is the end of the introduction of solvency management and capital modeling. And from now on, I'm going to explain ERM. We're going to explain ERM framework, and we'll explain some of the ERM practices that we are currently is using right now. ERM is a process, is not a certain material or a model. It pursues a permanent and sustainable core business strategies for long-term and risk-based return generation. Hence, is a process in a daily reinsurance businesses, such as risk-based business planning and supervisory reaction and sustainable capital allocation and in-depth analysis of each risk and comprehensive analysis on risk and business strategy with capital effectiveness. To make it very clear, all of the reinsurance business activities are related to ERM, which is core business strategy to enhance our capital and increase our ROE. ERM then is all the process that are related to those. For the first one, we are going to introduce an ERM process. ERM is to briefly enhance overall risk-based return. We call it RAPM of the company by using efficient frontier. Efficient frontier means less risk with higher return would be better. For the corporate objective in financial strategy, we are targeting, for example, ROE over 10% and net asset increase in 5%. And for the risk strategy, we are pursuing a portfolio diversification and increased shareholders' values and high credibility. For the risk strategy in detail, we have risk appetite and tolerances and risk limit. Risk appetite is which risk we are taking. We are pursuing an RBC in an optimal and a stable range and minimum ROE targeting that we are pursuing and minimum to low risk level that we are taking. For the risk tolerances is how much risk we are going to take. We pursuing a stable, CALOS is very minimum and stable credit ratings maintaining. For the risk limit, we have IBC limits and VAR, which is a risk limit, especially on insurance and investment. For the monitoring on a quarterly basis, we have a risk management committee, which is open up quarterly basis, and it review all of these risk strategies and corporate objectives. And in ORSA is an annual report, is reported on annually. We are generating and analyzing all of these processes in a yearly basis. To briefly more introduction on risk appetite and tolerances, it's closely related to definition of risk strategy. For currently, we are pursuing and maintaining insolvency ratio with an optimal range, and for the growth, focus on a business line with competitive advantages and achieve ROE higher than our target, and continuously improve low ROC, risk-adjusted return, and improve capital efficiency, and retain. We are pursuing a retain risk medium to low level. For the risk tolerances, we are pursuing maintain the solvency ratio with a stable and ability to fulfill responsibility at all times and maintaining credit ratings and annual net cat losses below some percent of our capital is closely related to the RBC ratio. Our key metrics introductions. This is kind of introduction of our end of 2020. RBC ratio is on a stable range, is optimal range that we are pursuing, and liquidity under stress by using our internal model. The worst case is far over our minimum level, so it's still very stable. And for the CAD exposures, our CAD exposures are well managed below our CAN limit. So all of those key risk metrics are fine at the end of 2020. This is the one of the example how ERM is working in a real company. Another one is a net CAN risk control. As I explained earlier, the most important one for the reinsurance company is a catastrophic risk. And we are modeling and controlling all of the net CAN risk. In end of 2020, we are resilient to CAT losses using our CAT models introduced earlier. By effective management of the accumulated losses under our capital buffer, so we are very fine with net cat risk as well. And the next one is stress scenario analysis by using economic solvency ratio. There was a COVID-19 pandemic recession and financial crisis, and net cat losses that we have simulated based on this stress scenarios is mainly because for ongoing active capital management, stress scenarios are updated regarding our historical losses and industrial experiences and potential losses. We also having a reverse stress test is also conducted, such as 1 in 1,000 year net cat events, and all of the stress scenarios and reverse stress scenarios, their chances of happening are very lower, and we are well managed with this stress scenarios. Here are this is the example of portfolio optimization, like a capital allocation for, especially this is on a strategic asset allocation and investment. We first categorize investment asset by risk level, such as low to high, and minimum risk portfolio. It means if there is the same return, one option is a low volatility and the other one is higher volatility. Volatility means a risk. Then the company choose lower volatility, lower risk with same return. This is efficient frontier method. And then by using this method, we are optimizing our investment portfolios based on this kind of risk return analysis. If our company is targeting high risk and high return, then we are going to choose the strategy E. But if you are pursuing the lower risk and low return, then we are going to choose A in this example. For depth and tightening investment deliberation processes, we also have kind of process to control the risk and return analysis for each asset in detail. Once we have invest in such as project financing and corporate acquisition financing loan, we have thoroughly review the LTV and deal structures and lender's credit. This is one of the newly came up agenda that reinsurance companies are dealing with very important. It's emerging risk. Emerging risk is a newly emerged and a atypical risk with a high potential of having a negative impact on the company. We are controlling our known risk, but if there is an unknown risk comes up next year, we are are experiencing very high potential of loss, then we are reviewing all of those emerging risks annually. We first identifying emerging risk by uh, ideas from each business team and benchmarking and other opinions from outside, such as CRO and ERI forum. Then we are analyzing scenario analysis. Think tank consisted by experts of each sector analyze relevant scenarios to assess their potential influences based on the amount. Then we are determining top emerging risk and risk mitigation actions if required. Top emerging risks are chosen at the end of each year, and risk mitigation actions are decided in line with the scenario analysis that we've experienced. They are described in detail and feasibly. And then we are regularly monitoring on those top risks and evaluated as to how well they are managed. And all of this process to report to our risk management committee and if BOD if necessary. Here are the example how ERM works well in Hanover. They are a performance indicator annually to improve their ROE, and they are evaluating their overall profitability above margin by requirement expected. And they are strong by using this ERM framework. They are experiencing a strong earning track record since 2009, and Hanover Re is one of the most profitable reinsurance right now. So we currently also targeting to manage our control and our ERM process to build up our ERM more strongly. Well, currently in ERM, we are pursuing a permanent and sustainable business strategy to long-term risk-based return generation. And it divided into three categories. The first one is risk strategy, and second one is control, and third one is activities. For the risk strategies, we have strong risk appetite and tolerances as shown earlier, and we also have coherent business strategy with following this risk appetite and tolerances. And then we are analyze our risk and return quarterly and annually to pursuing this strategy. For the control, we have risk limit annually in reinsurance and investment side and monitoring on a quarterly basis. And by using governance structures, we are strictly monitored and controlled on those activities. For the activities, it divided into reinsurance and investment. All of two processes are strategic asset allocation based on the capital allocation. And then we are also conducting a stress test and CATs accumulation and management separately to control very tightly. Here are how we are reacting and co-work with regulatory risk control by using our ERM framework. The definition of risk, if we call it identification, is we define a type of risk that a company is facing. In this regard, all of the business areas, including insurance, reinsurance, investment, and management, and change risk to number we call it quantified processes, because our activities, all of the activities should have changed to numbers, the risk to control afterwards. And there's another area, we call it quantified risk. Then all of these numbers quantified and then summarized by economic capital and required capital and risk that we've explained earlier. There are three pillars to control all these processes. There are three pillars, and the first one is a solvency ratio. This is a quantified risk, and all of this quantified numbers and the risk and available capital is controlling on the solvency ratio regimes. And the pillar two, we call it RAS and OSA. RAS means risk assessment and application system, and OSA means own risk and solvency assessment. This is more like a qualitative and quantitative evaluation by underwriting, investment, and management by monitoring and how the company is controlling their solvency ratio and risk limits and control. And the pillar three is a disclosure, is objective and reasonable public disclosure on all of these processes. Currently, Korea use RBC in pillar one and LAS and OSA in pillar two and disclosure in pillar three. And from 2023, pillar one will be changed to K-ASEAN, and pillar two, still we are expecting LAS and OSA. By comparing to European regulations, Europeans, they are using Solvency II in pillar one and OSA in pillar two, and disclosures are same. Well, this is a brief introduction of risk and reinsurance and introduction of our company and capital modeling and the ERM process. And I expect your understandings of reinsurance risk and ERM will be enhancing by hearing these classes. And once again, really appreciate to participate in this class. And if you have any questions and if you need additional information, feel free to contact me, Michael Seok Gyou JIN, by using this email address. Thank you.